Hi, this is Wayne Zell, and welcome to Blueprint for Wealth's educational moment. We're going to be talking today about selling your business, and this is part one of a multi-part series that will help you get your business ready for sale. So let's get started. The overview is that we're trying to do some corporate house cleaning. We want to do some due diligence on ourselves before we unleash a prospective buyer on our books and records. So the first thing we're going to do is look at our minutes to authorize prior acts as well as future acts that need to be approved by the board of directors or shareholders. We're going to make sure that we've filed with all the appropriate jurisdictions and states. We're going to examine our financial statements, and we're going to dig into that a little bit. And then we're going to talk about legal compliance and due diligence in a little greater detail. When I say we need to update our minutes or our consents, if you're a corporation, you must have formal approvals by your board of directors and your shareholders of certain acts that need to be approved on an annual basis or from time to time. So when we mention that we need to ratify prior acts, that means we're approving things that we did in the past, and that would include electing our officers and directors. Approving leases that we entered into for long-term leases, capital or operating leases. Loans that we may have borrowed money or lent money to third parties. Approving of any benefit plans that we may have adopted for the benefit of our employees, including 401k plans, profit-sharing plans, qualified retirement plans, and health benefit plans, medical plans, dental plans. All of those things need to be approved at least by the board of directors, depending on what your bylaws say. And lastly, we want to make sure that any stock that has been issued to shareholders, including the founders, has been approved, and any stock options and the plans approving of the issuance of those options have been approved by the board of directors and shareholders if required. When we're talking about approving new transactions, you're about ready to discuss the sale of your business. And so you may receive an indication of interest. You may receive a letter of intent. When you narrow down the letters of intent to one and you want to sign it and to the exclusion of all others, your board of directors should approve it and should send it for approval to the shareholders. When you have negotiated the definitive agreement, the purchase agreement, with the prospective buyer, we want the board and the shareholders to sign off on those documents as well. So we're going to have a consent of the directors and shareholders or a meeting where it's duly called in accordance with your bylaws and approved at the meeting. And so minutes need to be taken and included with your corporate records. And last but not least, I didn't include it on the slide, you need to have a stock book with all of the stock certificates at least copied front and back and signed, and a stock ledger that indicates what stock certificates were issued to whom and when they were canceled and reissued. Part of the due diligence process, part of your corporate house cleaning is going to make sure that you have all of your organizational documents in order and that you filed with the state and local jurisdictions that you're required to file with. Your articles of incorporation or your certificate of incorporation were filed at the time the entity was formed. And if you amended them, you want to make sure you have copies of the actual filed versions, not what you sent to the state, but what you received back, including a certificate from the state indicating that you were filed as a corporation or a limited liability company, depending on how you're structured. Any amendments that were filed with the state, you want to make sure it's in your corporate books and records. If you're a corporation, you need to have bylaws, which is the contract between the shareholders, the directors, the officers, and the corporation on how the corporation is run. If you're a limited liability company, an LLC, you'll have an operating agreement. And if you're a corporation with 2 or more shareholders, you may need a shareholders agreement as well. The buyer is going to want to make sure that the business that they're buying is in good standing, meaning that they are properly formed, but also in compliance with current law by filing annual reports and paying any fees that you have to pay to the state, including franchise taxes, which are payable in states like Delaware and Virginia. If you were formed in Delaware and you're operating in another state like Maryland or Virginia or Florida, you need to make sure that you have registered as a foreign entity in the states in which you're operating. It's a little more complicated than just saying, well, I have an employee there. But if you have an employee there, an office there, you're selling from that location, or you're keeping inventory at that location, or you've got property located at that location, you're going to want to make sure that you are filing properly in all of those jurisdictions. It's not just sales tax or use tax or payroll tax or even income tax. You actually have to file as a foreign entity. And lastly, if you are an S corporation or treated as one, because remember, an LLC can elect to be treated as an S corp, you want to make sure you have the official letter that was issued to you from the Internal Revenue Service when you were granted S corp status. The buyer always looks for that. With regard to your financial statements, most of our clients who sell their businesses are doing their accounting on the cash basis of accounting, meaning that they file their tax returns on a cash basis and they don't accrue accounts receivable on their books and records or accounts payable or other accruals that you would normally reflect an economic revenue number or an economic expense number. They're only doing cash basis. The buyer is going to want you to make representations and warranties in your agreement that your books are prepared in accordance with GAAP, generally accepted accounting principles, which requires accrual basis accounting. So you may need to restate your financial statements. It's not a big deal to do that, believe me, unless you've got significant amounts of inventory, and then it becomes a little bit more complicated. But have your accountant come in and prepare GAAP-based financials to match and reconcile to the cash basis financials. These financial statements will account for liabilities of all kinds, including ones that may not be officially recognized on your balance sheet, but may be disclosed in footnotes to the financial statements. The footnotes, which are also in accordance with GAAP, reveal the method of accounting that you're using, how you're recognizing revenue and accruing expenses, how you're depreciating your assets, how you're maintaining your leases and accounting for them, and how you're accounting for your equity in the company, including stock options, phantom stock, and other deferred compensation arrangements. The last point on financial statements is whether or not you are going to show the buyer that you've had some diligence done by an outside third party on your financials. The difference is significant. If you just hand your financial statements over, your QuickBooks or whatever you're using, over to your accountant at the end of the year and have them prepare financial statements, that's known as a compilation form of engagement, which is the least rigorous, the lowest cost, but also it doesn't give the buyer any assurance of the validity or accuracy of your financials. If you have a review done by your accounting firm, they may perform some analytical procedures to make sure that there's nothing truly unusual about the numbers that you're giving them to report in the financial statements. But if you do an audit, then you're getting an assurance from the auditors that your financial statements are prepared in accordance with generally accepted accounting principles with no exceptions, hopefully, and that gives you an unqualified opinion, and that's what buyers are really looking for if you can afford it and you have the time to do it. Last but not least is legal compliance and due diligence. This is where you get your attorneys involved. And if your attorney is a specialist like a government contracts lawyer, or you've only used your lawyer for technology purposes to register trademarks or patents, you are going to need other lawyers involved to help you do your due diligence and do your corporate cleanup to get you ready so that the buyer comes in and looks at everything and says, wow, these people really have it together. The first thing they're going to do is make sure that your equity ownership is properly reflected in your books and records. And that means stock certificates are issued, they're recorded, and that you have subscription agreements for the stock. It also will include approvals of stock option plans and any issuances of stock or stock options under the plan. It will have a clear understanding. The lawyers will have a clear understanding, and you will have records relating to all of your borrowing that's currently outstanding, including COVID-19 type relief that was provided by the federal government, such as payroll protection plan loans. You're going to want to make sure that somebody, either internally or externally, catalogs all of your active contracts, and then make sure that if you do have contracts with customers or vendors, are they assignable in a sale of the business? Even if you sell your stock, can you do so without requiring the consent of your contracting party? Taxes are another very difficult and complicated area of legal compliance and due diligence. You're going to want to make sure you've paid and filed all your sales tax, payroll tax, income tax, and any other tax that is owed by the company to the taxing authorities. You're going to want to have good records of all of the returns that you've filed with the IRS or the state or wherever you reside. You're going to want to make sure you have copies of all the returns, and you're going to want to have evidence of the actual filing. If you have that in your files, it'll make life a lot easier for you and the buyer when they come around. Your employees are another critical area. Do you have I-9s for every employee? In other words, did you check their immigration status or their citizenship status when they were employed? If not, you'd better get it in the records now for every single employee. Do you have non-competes, non-disclosure agreements, and non-interference agreements with your employees? You, at a minimum, are going to need non-disclosure agreements. And then, have you accounted for and reported properly for all of the employee benefits that you're providing to your employees? Are you treating independent contractors properly? Are they truly independent contractors? Have you handled the situation where an employee is listed as being exempt from overtime? And have you actually verified their status to make sure that they truly are exempt versus non-exempt, where they would be required to be paid overtime? Do you have any litigation pending against you, or any threats of litigation or claims? Any governmental investigations? Any IRS audits? You need to disclose all of that to the buyer, so you might as well get all that information together. When it comes to intellectual property, privacy laws now, and data protection, the buyer is going to want to make sure you have valid licenses to everything that you're using in your business that would constitute intellectual property, such as software, software licenses, trademarks, patents, copyrights, trade secrets, and know-how. If you own real estate in your company, you're going to need to have detailed information regarding the real estate, whether or not it's subject to current zoning regulation, and whether or not there are any environmental violations. And if you're leasing the real estate, you still are going to have to give reps and warranties regarding environmental issues, particularly depending on the type of business that you operate. And lastly, but not least, you want to make sure that you've got your customers and your vendors documented well. You want to know who your pipeline of prospective customers and contracts are, and you want to make sure that you've got a complete list of all of these people available to you, so that at the appropriate time, after you've got a signed letter of intent and after you've negotiated the critical terms in your purchase agreement, you can turn over this very secret information to a prospective buyer. Or you may want to wait until after you've signed the definitive agreement and give them a chance to do due diligence on your customers particularly. So that's what I've got for you in part one of Selling Your Business. You're listening and watching Blueprint for Wealth, and thanks for tuning in. Tune in next time for another special topic and special guest on Blueprint for Wealth. I'm Wayne Zell. Have a great week.